Good afternoon, everybody. Warm welcome to all of you. I must thank Mr. Ameet Patel. Do you know that this is the 6th time we have invited him to speak, and that just shows the extent of his popularity with our members. And one of the reasons why he's so popular is that he's an absolute money lifer. He's blunt, to the point, and unafraid, unlike all the talking heads that you would see most of the time who will make polite PR noises. That's the last thing that Mr. Patel does. To give you a little more formal introduction, Ameet Patel qualified as a chartered accountant in 1986. He is a brilliant student and a rank holder at the intermediate and final CA examinations. He also received the Rotary Award for Best Student of Narsi Munji College for participation in various activities. He is a partner of Sudit K Parekh and Company. He heads the firm's practice related to financial services. He has over 27 years of experience in handling various aspects of taxation, both individual and corporate. He's handled tax return preparations and filing, representation and litigation, transfer pricing, salary structuring, certification, tax audits, international taxation, etc. So 3 publications published by BCAS, and like I said earlier, he's been writing several times for Moneylife and at least 2 major cover stories. So with these introductions, I now hand over the mic to Mr. Ameet Patel.
Thank you so much, Sucheta, for that very elaborate introduction. I'm delighted to be here for the 6th time. I like to speak to the Aam Aadmi, not affiliated to any party. In the past, as some of you, if those of you who have attended the earlier meeting where I have spoken on the budget, would probably recollect how strongly I had come out on the then Finance Minister, Mr. Chidambaram. He was my favorite punching bag, and I used to enjoy trying to find faults with his budget speech and his various actions that he took. And I strongly believed at that time, and I continue to believe, that all that he did was extremely damaging to the common taxpayer. And I, being a common taxpayer, felt very vehemently about those things, and that is the reason I spoke out. Today, we are here to talk about the first budget of the NDA government, one of the most anticipated events. Of course, a lot of people feel that budgets have become really hyped up, but I think apart from the fact that it was the budget, I think it was the first major item on the agenda of the new government, and that is why also people were looking forward to it. So what did the Aam Aadmi expect from the Modi budget? Obviously, we all expected Achhe Din, because that was what was promised to us in the election campaign. On the radio, on the TV, or in the newspapers, in magazines, on Twitter, on Facebook, everywhere you read, everyone talking about the Achhe Din. So the question is, have those Achhe Din come? Some of the important expectations that a lot of people had from the budget that Mr. Jaitley presented yesterday, there were lots of expectations. A lot of common people, the retail taxpayers, individual taxpayers, they were obviously looking at reduction in the tax rates and or changes in the tax slabs. The other, of course, is the simplification of the tax laws. As Sucheta mentioned, in the past we have written about the extortionist attitude of the income tax department. And so therefore, a lot of people were hoping and expecting that there will be changes on the front of simplification of the tax laws. Then, of course, there was a need for bringing in steps for reducing inflation. It is killing inflation. In fact, people are saying that the prices have gone up after the NDA government has come into power. So there was a strong necessity for the FM to make some reference to inflation and give a roadmap as to how he would counter it. Another very important thing that people were looking forward to was the introduction, or rather the implementation of GST, goods and service tax. Then, over the years, we have been hearing that subsidies are what is creating all the deficits, and people are paying, the taxpayers are paying for other people, etc. So there was a hope, there was an expectation that there will be something on the subsidy front. Then, of course, the economy has gone to sleep in the last few years of the UPA's government, and people were hoping that the economy will be spurred by the budget by the Finance Minister, and some policies will come out whereby the businessman of India will get motivated, will get excited, and the consumption story will start all over again. Then there was also an expectation that the no-nonsense Prime Minister that we have will put an end to populism. And just as we saw in the precursor to the railway budget, there was an increase in the rail fares, and that was counter to the earlier government's practice of bringing in populism at the cost of the national economy. So there was a clear expectation that populism will be shunned by the new government. And then some of you would have read in the papers and may be aware even otherwise about the retrospective amendments made in the past few years, particularly the retrospective amendment coming out of the Vodafone judgment. And there was a lot of talk in the media that these retrospective amendments, particularly the Vodafone related one, would either would get removed from the Income Tax Act. And then there are the GAR provisions, the General Anti-Avoidance Rules, which Mr. Pranab Mukherjee had brought when he was the Finance Minister. And those are coming into effect from 1st April 2015. So there was an expectation, there were some media reports that the GAR provisions will also be either postponed or just completely removed. And lastly, there was a need to send out clear signals to the foreign investors that the Indian economy is back on its feet. The government is committed to bringing in stability, removing uncertainty, etc. And therefore, it's the right time for foreign investors to come back to India. So these were some of the important and popular expectations. At an overall level, what has the Finance Minister given us? First of all of us are aware he spoke for more than 2 hours, a marathon speech. He himself got tired in the middle. He had a health problem. Apparently he had been working 18 hours a day for the past several days, and that created a problem in his back. So a marathon speech, but there are not too many heavy-duty policy decisions. There's no indication, a very clear indication about what is going to happen about inflation, how they propose to tackle it. There is no rollback on the retrospective amendments. There are a few changes aimed at reducing litigation. I'll come to that a little later. There are quite a few changes affecting the stock markets. So those of you who are investors would be affected. I will speak about them, and I'm sure Debashis will also touch upon that. There is a clear resolve to push the GST forward. That is extremely good news. Then there is a plan, or there was a mention that a committee would be set up to review expenditure of the government. I think this is commendable. If it is actually carried out, I think it will be great news for Indians. There is also a resolve to reduce wastage of food grains, and that is something extremely important because we have a situation where we are surplus, agriculturists, but at the same time, millions of people are dying of hunger. And there are lots and lots of more other changes in the finance bill. So let me start with some of the direct tax provisions or direct tax proposals. First thing, which is a clear thumbs down for all of us, is that there is no change in rates of taxes. So the 10%, 20%, 30% tax rates remain same. There is no abolition of, or there are no changes in the surcharge and the education cesses that are levied. So where the income exceeds 1 crore, that surcharge of 10%, the education cess of 3%, which is charged on the tax and the surcharge, those will continue. And another thumbs down is in respect of the dividend distribution tax, the DDT, which has to be grossed up now. I'll come to that a little later. On the other hand, on the positive front, the tax slabs have been increased. And I can tell you that this must have taken him a lot of pushing for him to have done this. Frankly, I never expected any changes in the tax rates or in the tax slabs. But he has changed the slabs and by 50,000 each for senior citizens less than 80 years of age and for the junior citizens who are less than 60 years of age. So for senior citizens, it has gone up from 2.5 lakhs to 3 lakhs. And for the non-senior citizens, it has gone up from 2 lakhs to 2,50,000. That is the threshold limit. For those above 80 years, there is no change. So that 5 lakh slab, the threshold limit of 5 lakhs continues. So the slab rates would look like this now. for most of us sitting in this room, those who are below 60 years, up to 2.5 lakhs, no tax. Then on the next 2.5 lakhs, 10%. Thereafter on the next 5 lakhs, 20%. And on the income exceeding 10 lakhs, 30%. For senior citizens, other than the very senior citizen, that is other than the people who are more than 80 years, up to 3 lakhs, no tax. The next 2 lakhs, 10%. The subsequent 5 lakhs, 20%. And thereafter, 30%. So effective tax rates would look somewhat like this. Individuals who are earning more than 1 crore, who will have to pay the surcharge of that 10%. So 30% plus 10% surcharge comes to 33, and 3% of that comes to 0.99. So 33.99 would be the effective tax rate in the top bracket above 10 lakhs. For corporate tax, domestic companies where income is less than 1 crore, or for all categories of companies, whether domestic or foreign, irrespective of the income, the tax rates remain same as last year, 30.9, 32.445, etc., etc. All included, surcharge, education cess, everything wherever applicable. For firms and limited liability partnerships, again, no change. So income up to 1 crore, 30.90, and income exceeding 1 crore, 33.99%. So these are the effective tax rates for the current financial year relevant to assessment year 2015-16. There are certain changes with reference to the deductions that we as common citizens get from our gross total income. So our taxable income gets reduced by certain deductions. And there are a few changes as far as these are concerned. The first one is, of course, this is, not a Chapter 6A deduction, wrongly put, but it comes amongst the deductions. The most important one that a lot of people in the country claim benefit for is in respect of the interest on housing loans. So where you have a self-occupied property, there is a limit, currently there is a limit of 1.5 lakhs in respect of interest that you pay on the housing loan. So if you have taken a housing loan and you are using the house for your own occupation, it's called a self-occupied property. On that, obviously, there is no income. You don't get any income because it is self-occupied. But you are allowed to claim a deduction of up to 1.5 lakhs till last year. So that 1.5 lakhs, up to 1.5 lakhs, you could claim as a deduction against your other income. So if you had salary income, business income, or interest income, etc., you could reduce that income by 1.5 lakhs in respect of interest on housing loan. That has been increased to 2 lakhs. And one thing that you may keep in mind over here is that all of you would be aware, of course, this is not emanating from the budget, but I just thought as taxpayers, it would be a good point to keep a note of, that in respect of housing loans, the repayment of the loan also entitles you to a deduction under Section 80C. But that is available only if the loan is taken from the financial institutions, etc., like HDFC or LIC Housing Finance, etc., from a limited number of institutions that give out these loans. So if you have a private loan from a relative or a friend or from your own company, etc., maybe it is for the housing. But when you repay that loan, you don't get a deduction under 80C for that loan repayment. Whereas for the interest payment, the deduction is available irrespective of who is the person who has given you the loan. So private loans taken, repayment will not entitle you to benefit under 80C, but interest on housing loan will give you a benefit up to 1.5 lakhs. And now going forward up to 2 lakhs. Then under Section 80C. 80C is, I think, the most commonly used deduction section by most of us. It gives you deduction in respect of payment of life insurance premium, investment in national savings certificates, investment in public provident fund, investment in those 5-year bank deposits, etc., etc. There are several items over there. Also, the repayment of the housing loan, as I mentioned. So that upper limit is 100,000 or 1 lakh rupees. That has been increased to 1.5 lakhs. The PPF limit, in his speech, Mr. Jaitley mentioned that the limit of the money that you can put into your PPF account is also going to be increased to 1.5 lakhs. Presently, it is 1 lakh. So simultaneously with the amendment in Section 80C of the Income Tax Act, he said that he will also amend the Public Provident Fund Act. Now here the only point that I've tried to highlight over here is that the PPF limit is going to be increased, whereas the ATC limit is already increased by way of this budget. Of course, we are presuming that the budget will be approved by both the houses, but that is generally only a matter of formality. So PPF Act needs to be amended. So today, for example, if you go to your State Bank of India or wherever you have your PPF account and you give a check of 1.5 lakhs, in all probability that clerk sitting over there will not accept it, because he or she is not yet aware of the changes that the Finance Minister has promised. The Act needs to be amended first, only thereafter the PPF guys will start accepting up to 1.5 lakhs. ATC limit is increased, so you can put totally in different instruments aggregating to more than 1 lakh and up to 1.5 lakhs now. Past experience shows that earlier the limit under ATC was 70,000. Under PPF Act also it was 70,000. It was increased to 1 lakh under Income Tax Act, but the PPF Act amendment took a long time to come. So we had a situation where ATC limit was 1 lakh, but PPF limit was 70,000. So you could not put the entire 1 lakh into PPF at the earlier time when the amendment was made. That is the only point I wanted to draw your attention to. So the changes in the slabs, the increase in the deduction for interest on housing loan, and increase in the limit for deduction under Section 80C. These three are the important changes which will help almost every taxpayer in the country, the individual taxpayer. And if you just see the table, I've given an example that if the income is 18 lakhs and currently you are paying whatever interest you may be paying, but you are getting a deduction of up to 1.5 lakhs as far as housing loan interest is concerned. ATC, whatever you may have been putting, the upper limit currently that you get is 1 lakh. So your taxable income came to 15.5 lakhs. Tax payable on that after adding education cess was 3,03,850. Going forward, same level of income, 18 lakhs. You get an extra deduction of 50,000 for housing loan, extra deduction of 50,000 under ATC. Your income comes down by 1 lakh to 14.5 lakhs. And in tax on that, along with education cess, is 2,67,800. So saving of 36,050. So anyone who is in the 30% slab above 10 lakhs is going, and provided of course he is paying this housing loan interest as well as utilizing the full limit under ATC, the maximum benefit in terms of reduction of taxes would be about 36,050. If your surcharge also comes into the picture, then that amount would slightly increase. So the Finance Minister in part has shown a glimpse of the Achhe Din for us by putting in 36,000 extra in our hands for the consumption or saving purposes. Capital gains is something that affects a lot of us. Many of us are buyers, investors in shares, mutual funds, etc. A lot of people sell houses and all. There will be capital gains. There are several changes affecting capital gains. The first one is with reference to sections. Generally, I don't mention sections, but I think it is very relevant over here. So therefore, I have put the sections 54 and 54F. These are the two sections under which a person who has earned long-term capital gains from the sale of a residential house property or any other asset. So that's why you have two different sections. So one section deals with residential house property and the other with any other asset. So when you have a long-term capital gain from the sale of any asset, the Income Tax Act allows you to claim certain exemption in respect of that capital gains by investing the money in a new residential house property. So, and there is a time period given that you could have 1 year before or 2 years after the sale of the asset purchased a house, or within the next 3 years constructed a house. So time limit is there. There are certain other conditions. Those conditions have not changed. Time limits have not changed. But a very important change that has come is this, that today what was happening, that suppose I had a house, I sell the house, And to claim exemption, I had a particular time period to invest in a new house. So the loophole that people tried to find was that the exemption was available in respect of investment in house property. That was the wording. So people were misusing that and buying two houses, maybe next to each other, or maybe one in one building and another in the other building, and saying that I have bought a house property and I should be entitled to the exemption. So people were claiming exemption by investing in two houses. Invariably, it happened that a large family living in South Bombay flat sells it and buys two houses in the further down in the northern suburbs, and that was a need of the family. And people were taking exemption even then by saying that I have complied with the conditions laid down in these sections. The second was that nowhere in either of these sections is it mentioned that where should you buy the new house. So a lot of people, especially about 6-7 years back, when in USA there was a crisis, and subprime crisis brought down the prices of the houses, and thousands of houses came onto the market for sale. People started selling off the houses in USA. A lot of Indians have invested in houses in America, massive apartments or massive bungalows, etc. And they claimed exemption in India on the ground that I have invested in a house property. So the very patriotic government that we now have obviously has caught on to that. I'm not finding faults with that. I personally feel that it is only fair that if you are giving benefit to a taxpayer in India and reducing his taxes, then that benefit of the savings must remain in India. So therefore, there are two changes as far as these two particular sections are concerned. One is that the exemption would now be available only in respect of one residential house, purchased or constructed as the case may be. And the other condition is that that new house should be in India. So this is a very major change. It will affect a lot of people who have already claimed, who have sold a house and who are planning to buy two houses. And there is a lot of controversies. There are some decisions which say that when you buy two houses next to each other and there's a common kitchen, it can be considered as one house. Then people went on to say that why next to each other? I can go, first floor, ground floor, and yet have a common kitchen, and I should be entitled to this benefit. So there was a lot of litigation on this front, and in various cases, different decisions have come. But I think one good thing is that this particular amendment will clarify the law, do away with the ambiguities, and therefore reduce litigation on this particular matter. Another change as far as long-term capital gains is concerned is with reference to the section 54EC. Under this section, so you could have either saved your long-term capital gains tax by investing in a house, or you can buy the bonds issued by Rural Electrification Corporation of India or National Highway Authority of India, NHAI. In the section, there is a limit of 50 lakhs per financial year. So the section says that you can invest only up to 50 lakhs in one financial year. And a lot of people, with the help of advisors, had taken a stand and had planned the sale of their houses or whatever other assets in such a way that the sale took place somewhere at the end of the financial year. So what happens, for example, you sell your house in the month of January 2014. Now the time limit given for investing in the bonds is 6 months. So you have up to July 2014 to invest in the 54EC bonds. So what the taxpayer did was, he put 50 lakhs immediately before 31st March in the 54EC bonds. And thereafter, so the first condition is that 50 lakhs per year. So in that first financial year, 50 lakhs, no problem. Then immediately after 31st March, the new year has started. So he put in another 50 lakhs before the 6-month period ended. So before July, another 50 lakhs were invested in the 54EC bonds. Thereby, the exemption under this section was claimed up to a limit, up to the extent of 1 crore rupees. So this clearly was not the intention of the government, but a lot of people were misusing the section, the anomaly or the loopholes in the section, and were doing this. So now the amendment has come clearly to say that the limit of 50 lakhs applies to this year one as well as the next year, the immediately succeeding financial year. Obviously, that 6-month period can't go on to the third year. So therefore, that loophole is plugged now, and total exemption that you can get under 54 EC now with reference to a particular sale would be 50 lakhs only. But this has given rise to now another controversy which people like me are discussing with each other, as to suppose what happens is that in the same example that I gave, I sell my house in Jan 14, I put 30 lakhs before 31st March, and I say I have got time of 6 months, so 20 lakhs I'll put next year. So I put 20 lakhs in, say, April or May or June, whatever it is. Now, the way they have worded it, they have said that you can invest only totally 50 lakhs in this first year and in the subsequent year. Now, in the subsequent year, having invested, whatever, that 30 lakhs in the second year, in the month of, say, September 2014, I have some other capital gains. I have sold some other asset, and I have got more capital gains. And can I then invest, say, 40 lakhs in the same bonds? Is it permissible or not? That is a problem, because frankly speaking, what was happening was that taxpayers were misusing the provision to take benefit of 1 crore against 1 capital gain. But there should not be any problem in claiming 50-50 in 2 different years for different capital gains. But unfortunately, as a result of this amendment, this particular issue may arise. I hope that it would be clarified by the Finance Minister in the discussions that follow. Many of you may be having private limited companies, and many of you may be investing in units of debt funds or non-equity oriented funds. Those of you who have been sold all the FMPs by the various mutual funds are probably going to, be screaming at this proposal. FMP, what are the whole USP? The USP was that the holding period, the period of the product was around 370, 380 days, whatever, but issued in such a way that it spanned 2 financial years. So you crossed into the next year. You also crossed 12 months. So it became a long-term capital asset. So when it was redeemed, it was a long-term capital gain, and therefore you are entitled to indexation of the cost. Correct? So, and virtually, therefore, most FMPs did not give any taxable income, although they did yield 8, 9, 10, whatever percent of return that you got. So you got a profit, but it was not taxable because it happened to be long-term capital gains calculated after indexing your cost. Now what has happened is that for the purpose of unlisted securities and units of non-equity oriented funds, the holding period to classify that asset into long-term has been increased from 12 months to 36 months. So you will have to hold it for more than 36 months in order for that asset to be classified as a long-term capital asset. So if an FMP is there, whose life is less than 3 years, less than 36 months, then it will never be a long-term capital asset. So whenever you redeem it, it will be short-term capital asset. It will result in short-term capital gains, and therefore it will be taxed at the higher rate, whatever is the rate applicable to you depending on the slab in which you fall. And the other problem is that the section which says that long-term capital gains is to be taxed at 20% also gives, before this budget, it also gave an option to the taxpayer, an option to the investor to calculate tax at 20% based on after indexing the cost, or 10%, the tax at the rate of 10% on the capital gains calculated without indexing the cost. And whichever is more beneficial, you could pay that tax. So in many cases, particularly for example in case of bonus shares where cost is 0, then obviously the whole sale price would be the capital gains. So it makes more sense, and whether even cost is 0, indexed cost is also 0. So 20% on indexed gains and 10% on unindexed gains obviously 10% would be better. So people had that option. It was a good option. Now that option has been done away with as far as units of debt funds are concerned. So therefore, the investor now has no option to pay tax at 10% on the capital gains calculated without indexing the cost. He is mandatorily required to pay tax at 20% after indexing the cost. Another important change as far as capital gains is concerned is that you may enter into an MOU with someone to sell who is willing to buy your house, and you get an advance. So you get 50,000 rupees as advance, and then something goes wrong and the deal breaks off and you forfeit that 50,000 rupees. So the change that has, so up till now what was happening was that whatever amount was forfeited was to be reduced from your cost price of your house. Whenever you sold it, when you calculated capital gains, that whatever was the cost had to be reduced by the amount forfeited. Now the change, before that, so when that happened, suppose your house had cost you 10 lakh rupees some years back, and you had got 50,000 as advance from someone, and the deal broke off, so you forfeited that 50,000. After 5 years, you sell the house for, say, whatever, X amount, forget the sale price. But when you are calculating the capital gains at that time, 5 years later, your cost would be 10 lakhs minus 50,000. So that directly impacted your long-term capital gains from the sale of the house property. Now what the Finance Minister has proposed in the budget is that that amount which you forfeit will not be considered as anything other than income from house property. So it becomes, it will be taxable as income from other sources in the year in which you forfeit it, and therefore it will not have any impact on your capital gains as and when you actually sell your house. So there is a straight impact, there is a double impact. One is that earlier you were postponing the taxability of that amount by whatever years till you sold the house. If you did not sell, then that was free money for you. So that is one. So that is no longer possible. And the other is that earlier it was impacting your capital gains. Capital gains is taxable at a concessional rate of 20%. Whereas income from other sources is like your normal salary income, interest income, house property income, business income, etc. And whatever slab you fall in, it will only add to that income of that particular slab, and therefore you'll be paying, you might end up paying tax at a higher. So if you are in the 30% bracket, you'll be paying tax at 30% instead of the earlier rate of 20%. Dividends. Massive change as far as dividend distribution tax is concerned. It's going to affect companies and mutual funds, and obviously when it affects companies and mutual funds, it is bound to adversely affect the shareholders and the unit holders. What is the proposal? So if you look at the left side of the screen, it is the current position before the amendment in the budget. Let us take an example that the amount that is distributed by a company, this is in respect of a company, not mutual funds. So a company declares dividend and pays to Debashis 85 rupees. So he gets in his hands 85 rupees as dividend. And the DDT rate, the dividend distribution tax rate, is 15%. So the company which pays 85 to the shareholder has to pay a DDT of 15% of 85 rupees, which is in this case 12.75. So total outgo as far as the company is concerned is 85 of dividend and 12.75 as tax. So net the grand total is 97.75. So presently the DDT is calculated at a simple rate of 15% on the dividend which is declared. The government feels that this is not fair, and actually what the shareholder should get in his hands should be net of tax. And therefore, they have said that the DDT, the dividend distribution tax, should be grossed up by the company which is declaring the dividend. Which means that, in the same example, if you are, as a shareholder, getting 85 in your hands, that 85 should be, the tax on the dividend distribution tax should be calculated in such a way that the arithmetical formula works out to the manner that 85 is after paying the tax. So in short, in this example, same example, the gross amount on which DDT has to be paid would be 100. 15% of 100 is 15. So the company will pay 15 to the government, and 100 minus 15 is 85, and that 85 will go to the shareholder. So net, the shareholder gets the same amount, but the government gets whatever, 2 rupees and 25 paise extra, 2.25% extra. So the total outgo for that company which has declared the same, and the company which wants to maintain the same dividend, would be 85 as dividend and 15 as DDT. Total coming to 100. I have not taken into consideration the surcharge, education cess, etc. That will further increase the complication. But broadly speaking, this is the way the grossing up principle would apply. Then same principle is made applicable to the units, the mutual funds also. But in mutual funds, as you may be aware, the DDT rate is far higher. In some cases it is 25%, in some cases it is 30%. I don't know whether it is readable at the end, but for those mutual fund units where the rate is presently 25%, the amended rate will work out to 33.33%. And where the present rate is 30%, it will go up to 42.86%. This is absolutely ridiculous as far as the mutual fund industry is concerned. They might as well shut down, the debt funds and the money market funds and all those other funds, other than the equity-oriented funds, because naturally, when the mutual fund is going to declare a dividend, they will have to take into consideration this higher outgo. So if the fund has only 100 rupees to pay out, obviously it will have to work out in such a way that 100 is the total of what goes to the shareholder, the unit holder, and what goes to the government. So in hand, the unit holders will obviously get far lesser dividends as compared to what they are getting today. That being the case, who in his right mind is going to invest in these debt funds or money market funds or FMPs, etc.? If FMP is a different example, but wherever the dividends are being declared. So one immediate reaction could be that instead of going for an income fund, I would put my money in growth fund, so that I don't get dividend. There is no expense of DDT for the fund. But then you have to remember that the definition of long term has been amended. So it will take you have to first hold it for 36 months before it becomes long term. And then when you sell it, you get that lower tax rate. So either ways, I think the mutual fund industry is in serious trouble. Unless Debashis has found some other stuff to talk in we'll see what he says. But I personally feel they are going to lobby very, very hard against this proposal to the Finance Minister. And obviously this has come out as a result of the lobbying done by the banking industry, because banks were feeling that it's very unfair that for debt funds you give all these concessions, and for interest on FD there is no concession. It's fully taxable. They have to deduct tax also, etc. So from 1st October 2014, the new DDT rates will come into force. So till then, most mutual funds will try to give as much dividend as possible. But there will obviously be a limit to that. We need to be ready with our investment strategy post 30th September 2014. Some business-related changes. Those of you who have the unfortunate situation where you are doing business would know that you have to deduct tax from various payments that you make to other people. And if you default, as Sujata mentioned in that earlier article, we had brought out that there are all kinds of penalties, interest, disallowances, etc. There is a section which says that when you make a payment to anyone, whether it is a resident or a non-resident, and you do not deduct tax, then that expense is not allowed as a deduction from your business income. Then they have said that, however, if the tax is subsequently paid, then you still get a deduction. And there was a difference between, in this particular case, there was a difference between amounts payable to residents and amounts payable to non-residents. For residents, the position was that if you forget to pay TDS in year one, in the first year, Still, if you paid in the second year and before the due date for filing the return for the first year, so in short, for the year ended 31st March 2014, in that year you made a payment, you forgot to deduct tax, you had time up to 30th September 2014, which is the due date for filing the company's return for the year ended March 14. So you had time up to 30th September to deduct and pay to the government. If you did that, in the first year, the deduction for that expense was not disallowed. But for non-resident, when the same payment was to be made to a non-resident, there was no such leeway. So the deduction was available in the second year. When you make the payment of the TDS, the deduction was allowed in that year. So in the first year, you suffered a disallowance. In the second year, you got the deduction. So in many cases, it resulted in absurd situations, because in the second year, you may not have income, but you get a deduction. In the first year, you had income, you don't get deduction, so you had to pay tax. So that was a problem. They've done away with that issue. So now, whether it is a payment to NR or whether it is a payment to resident, if there is a default in TDS, and if you clear the default by the due date for filing the tax return, you get the deduction. Another problem was, as I said earlier, the expense got disallowed completely. So for example, you made a payment of 50,000 as professional fees to some consultant and forgot to deduct tax. The entire 50,000 was disallowed as an expense, which was a big, it was a massive hit to the taxpayers. And that was what was causing a lot of heartburn to the taxpayers and to the businessmen. Fortunately, this finance minister has, heeded to the representations made in this behalf, and he has said that the disallowance will be restricted to 30% of the expense, which is fair enough, because ultimately that amount may have been taxable in the other fellow's hands at 30%. Because of my default in not deducting tax, the government may have lost revenues, etc. So the disallowance will be restricted to only 30% instead of the current 100%. As a great move as far as that is concerned. But on the downside, earlier when you paid salary without deducting tax at source, the salary was not disallowable, unlike all other expenses. Now salary has also been brought into the same bracket. So if a businessman pays salary to his employees and forgets to deduct tax where it was deductible, then the salary, 30% of that salary would not be allowed as a deduction from the business income. Another big hit, and I don't know, the opinions can be divided on this, but all of you may have been reading in the newspapers about corporate social responsibility, CSR. The Companies Act 2013 has made it mandatory for companies to spend a particular percentage of their profits towards CSR activities. CSR activities is, to put it very, very crudely and simply, it would be somewhat like a donation to be made out for the purpose of betterment of the society. So instead of donation, the companies were supposed to spend actually on various activities, So there was an issue about the allowability of that CSR spend as far as the Income Tax Act is concerned. And unfortunately, the amendment has come that that expense will not be allowed as a deduction under Income Tax Act to that particular company. So this is, I think, quite an unfair one, because on one hand, you make it mandatory to spend money, and then you say, no, I will not allow you that amount as a deduction. It's unfair from one perspective, could be fair from some other perspective, I don't know, but I find it unfair. That's why, we have given it a thumbs down. Then last year there was a deduction, investment allowance brought in under Section 32AC for new plant and machinery installed. Last year's amendment is valid only for up to 31st March 2014. It was restricted to, the limit was 100 crores of up to 100 crores of new plant and machinery bought. Now he has brought in another subsection in that same section and said that for plant and machinery installed between 1st April 14 and March 17, up to 25 crores, you will get a separate investment allowance deduction. I think it's good. The deduction is 15% of the actual cost of machinery. Foreign institutional investors, those of you in the stock markets would know that, our markets go up or down depending on the FIIs. most of our blue chip companies are virtually owned by the FIIs. For them, there is certainly achhe din are here. And let me tell you why. Today, one of us sitting in this room does regular buying and selling of shares. There will be an issue in his or her tax assessment, and the ITO will say, or could say, that you are not an investor, but you are a trader in shares. So your profits or losses, as the case may be, from the sale of shares is not capital, does not amount to capital gains, but it amounts to business income. It doesn't take much intelligence to realize the importance of that stand being taken by the ITO, because capital gains, long-term, short-term, etc., on listed shares is entitled to concessional taxation. Long-term capital gains totally tax-free, short-term gains 15%. On the other hand, if it is business income, there is no exemption, so it will be fully taxable. So there is an issue, and a lot of litigation is already in place already taking place in India on this particular matter. Whether the capital gains earned by a taxpayer, according to him, it's capital gains, whether it is business income or capital gains. Rampant litigation, lot of case laws. There is no clarity as to when it can be held to be business income and when it can be held to be capital gains. For FIIs, same issue was there. In lot of cases, FIIs, you would be happy to note that when they invest, they don't invest in 500 shares and 100 shares or 1,000 shares like you and I would do. They would invest in 1 lakh shares, 50,000 shares, etc. The volumes are mind-boggling. The kind of transactions that they do in F&O, I had a client once where I got the data in an Excel sheet, and all from row 1 to the right down, 36,000 whatever, all rows were filled up. That was the volume of the F&O, and I got 2 files like that. That is the volume. Today, as an Indian, if you have 50 transactions, ITO will say you are doing frequent trading in shares, and therefore you are a businessman. FII is doing large-scale buying and selling of shares. There has been a huge demand from them that there should be clarity about the categorization of income. All of you, some of you may be aware that when an FII comes from Mauritius or Singapore, because of the tax treaty between India and Mauritius or India and Singapore, the capital gains earned by an FII in India is not taxable in India. It is taxable in Mauritius and Singapore. And in Mauritius and Singapore, the tax rate on capital gains is 0. So in effect, capital gains earned by an FII located in Mauritius or in Singapore from sale of Indian shares or Indian securities is not taxable in both the countries. Obviously, it's a huge advantage, and that is why FIIs have come in, because that is the USP for them. That is the reason why they invest in Indian securities. If we feel that they are in love with our economy, I think be highly mistaken. They are in love with the profits that they are making and which are tax-free. On the other hand, in a lot of other treaties also, in many cases, the gains are not taxable in India. They are taxable in the home country where there could be taxes. It is not that it is completely tax-free, which is fair enough. So obviously FIIs coming from Mauritius, Singapore always took a stand that whatever they are earning in India is capital gains. On the other hand, there were some FIIs which came, as I said earlier, from countries where the capital gains is not exempt in India. Or it is, so it is taxable in India. In those kind of cases, the FIIs wanted to take a stand that it is not capital gains, but it is business income. And the reason being that under the tax treaty, business income earned in India can be taxed in India only if that foreign party has what is known as a permanent establishment in India. I'll not get into the technicalities, but most of those people were able to convince the tax department that they did not have a permanent establishment in India, and therefore that business income was not taxable in India. So as it suited the FIIs, some took capital gains, some took business income. Matter has gone in appeal. Invariably, in all the cases, it has been held that an FII cannot be doing trading in India. The SEBI regulations itself says that an FII has to only invest in India. And on that very technical ground, it has been held that an FII always earns capital gains in India. Now, with a view to clarify the law and avoid the litigation. They have said that an FII, when it earns any profit or loss on sale of or transfer of Indian securities, it will always be capital gains or capital loss. So there is no controversy about the business income. There is no controversy as to whether that fellow had a permanent establishment in India. All FIIs will now always earn capital gains in India. Of course, if they earn interest and dividend, that is separate. But from the profit and sale on sale of shares, mutual funds, F&O, etc., will now always be considered as capital gains. This is a very, very major amendment, I would say, as far as FIIs are concerned. They wanted this, particularly the guys from Mauritius and Singapore. And incidentally, it was also there in the DTC. So this is not NDA creation. The direct tax code had identical feature. Only thing is that DTC has not come into force. So my question is, what about us? FIIs go away, by treating it as capital gains, and as Indians, we have to struggle with the tax officer when it comes to categorization of income from sale of securities is concerned. I would strongly hope that some clarity comes on this particular issue. For the time being, there is no mention of that. The issue of retrospective amendments. Every time the government lost an important case in the Supreme Court, they promptly amended the law with retrospective effect. And they always made that 1462 was their favorite year, favorite date. So everything was retrospectively amended with effect from 1st April 1962. On the ground that right from day one of the Income Tax Act, the Income Tax Act came into existence on that day. So on the ground that it has always been our intention that this is the way the law should be. So after 50 years, the intention gets clarified by way of a retrospective amendment. Vodafone case, which I referred to earlier, brought about one of the most, controversial amendments to the Income Tax Act 2 years back, with retrospective effect from 1st April 1962. That has contributed largely to the downfall of the government, apart from a lot of other factors, of course. But a lot of FIIs have clearly, probably funded our elections in order to get rid of the government who brought that kind of an amendment. That being the case, there was a strong expectation that the retrospective amendments would be done away with. A lot of media people had reported that, as I mentioned earlier. Mr. Jaitley has not touched that. So the amendment in the law stands, the retrospective amendment. However, he has said two things. One is that in principle, he is against retrospective amendments. So he said that generally we will not bring in any retrospective amendment unless there is a very, absolutely hard case for that. And the other is that as far as the existing cases are concerned, existing cases meaning existing arrangements which in future may be roped in because of the retrospective amendments. He said that if we want to do that, that will not be given, the powers to do that are not in the hands of the tax officer, but that will be in the hands of a high-level committee which will be set up by the CBDT. So I think the FM had two choices. One is to do away with the amendments, and the other is the better way and the simpler way which he has taken, which is that let the amendment be, but we will not use it. And I strongly believe that this government will not use the retrospective amendment going forward. Whatever has happened to Vodafone will remain because that can't be undone. But very quickly, I have a feeling that in the next few months, they will complete the arbitration process with Vodafone, close the case, recover a huge amount from them, which anyway they were willing to pay because the fact that they've come ahead for arbitration means that they've accepted that they will have to pay a liability. Modi will take that liability with the tax collection, and I think he will have a trump card on his table. That is my expectation. Let's see how things turn out. Again, those of you who have been giving loans or taking loans might be aware of two sections, very dangerous sections, 269SS and 269T. Under 269SS, if you accept a loan in excess of, I think 30,000 is the limit, otherwise than by an account pay check or demand draft, then you are violating the section, and in some cases that was being taxed as income, whatever was the loan amount. And then we had this whole, electronic revolution whereby you can transfer money sitting in any part of the world with the help of your mobile phone or your computer, etc. NEFTs, RTGS, etc. Internet payments, all the kinds of payments that you can make. So there was an issue that the wordings were account pay, check, and demand draft. So now they've amended the law to say that even if the electronic payment is done, it will not be considered as a violation of that section. A very welcome amendment. Only issue is that there are many cases where the loans have come into existence by way of journal entries passed in the books. So there is a lot of litigation on that front as to whether that amounts to violation of the section. A lot of decisions have held that yes, it does amount to violation, and therefore I would hope that that is also amended in the near future, maybe in the next budget or in this particular budget itself. Another very important development is the clarification brought in for REITs and InvITs, real estate investment trusts and infrastructure investment trusts. There was an issue about the taxability of the unit holders in these two trusts as well as the trust itself. So they have brought in a whole new chapter. They have amended several sections to bring in clarity on the taxation of the REITs and the InvITs. Considering the composition of this audience, I'm not going into the details. If anybody wants details, I would be happy to share it subsequently. Advanced pricing agreements is something that affects international transactions, may not be relevant to many of you, but the reason for including it is that this is one of the most welcome features of the budget. There has been a rollback provision brought into the APA. APA means Advanced Pricing Agreement, as I said, whereby before you enter into the agreement, you can go to the government and ask the government that what will be the tax impact of this transaction that I propose to enter into. So there will be no, the Vodafone kind of cases can be avoided, and you can have in advance clarity on the taxability of the transaction. And thereafter, if you feel that it's not worth getting into it because of the taxation, you may not enter into the transaction. But you have clarity upfront. So that is the APA regime. And now they have brought in several changes to make it better and make it more useful for the taxpayers. Another important amendment, I don't know how many of you will be affected, but you need to really go back home and see the fine print of your LIC policies. Today, when you pay life insurance premium, you get a deduction under Section 80C, subject to that upper limit of 1 lakh and now 1.5 lakhs going forward. But there is a condition that the premium should not exceed 10% of the sum assured. So if you have taken a policy of 1 crore, the annual premium should not be more than 10 lakhs. If it is, then forget the budget. I'm talking about the current position. If it is, suppose the annual premium is 11 lakhs on a sum assured of 1 crore. So it is more than 10%. Then you are not entitled to the ATC deduction, A. And B, when you get back the money from the insurance company, when the policy matures, that amount is not exempt in your hands. In the normal course, all of us very mechanically and blindly take every money that we get from the LIC policy, LIC company as exempt on the ground that when I get back the money, it is exempt under Section 10, subclause 10D. But even today, that example that I gave, it is not exempt. So it was supposed to have been offered for tax. But I have not come across any single taxpayer who has ever offered for tax these kind of amounts received back from the insurance companies. So to get hold of these kind of people who are not paying taxes on the LIC money received back, they have amended the law to say that the insurance company will have to deduct tax at 2% from the amount paid to the beneficiary, whether it is the sum assured or the accrued bonus on everything, provided the total amount paid is 1 lakh. So up to 1 lakh there will be no TDS, the threshold limit is there, but more than 1 lakh being paid out in respect of those policies where you are not complying with that condition, then there will be a TDS. So you will have to offer You were always supposed to offer that income for tax, but going forward, not only will you continue to do that, but you can claim credit for that, whatever tax that has been deducted by the insurance company. Please go through your policies and find out whether your policy falls in the exempt category or the taxable category. Indirect tax, I do not practice in indirect tax. However, I have just borrowed the slides from my indirect tax partner, and I'm bringing to you some of the salient features. Service tax remains unchanged at 12.36%. The tax base has been widened to include sale of space or time for advertisements through online and mobile advertising, and services provided by radio taxis or radio cabs, whether or not air conditioned. So if you hire a taxi or a radio taxi or a radio cab, the service charge that you pay will now attract service tax. There were certain exemptions for services of clinical research on human participants, services rendered by AC contract carriages like buses. Those exemptions have been done away with, so now they will be taxable. Meaning of auxiliary educational service has been narrowed down, and whereby the result is that earlier, if you had given out a property on rent to an educational institution, then on that there was no service tax was not required to be charged. That has been done away with, so you will now need to charge. That exemption is done away with. Ambit of exemption widened to include the following, with effect from, already it is effective: transport of organic manure by vessel, rail or road, etc., etc. There are certain things. Specialized financial services received by RBI from global financial institutions in the course of management of Forex. So some of these new items have been brought in, some of the exemptions have been done away with, and in this particular case, the ambit of exemptions have been widened, so these will now not be subject to service tax. Other changes: color picture tubes exempted from basic custom duty to make cathode ray TV cheaper and more affordable. To encourage production of LCD and LED TVs below 19 inches, basic custom duty reduced from 10% to nil. I don't know whether now the tablet manufacturers will start saying that they are TVs, just to reduce the custom duty. Specific rates of excise duty increase on cigarettes from 11% to 72%. Additional excise duty of 5% on aerated waters containing added sugar. GST, very big expectation. The whole country was waiting for some news on GST. He has clearly said that that is a priority, and we should thank the government for that. We hope that the GST will come in quickly, and he has promised to bring it before the end of the year. The FM has assured that all states would be taken on board for the GST consensus on a fair and equitable basis. It appears that the government will consider step-by-step approach to implement the GST. So first, the central GST will be brought in at the central level, and then the state level GST will be introduced to replace the current state level taxes. In particular, the CGST, the central GST, would consolidate central excise, service tax, additional excise duties, etc. The GST will streamline tax administration, avoid harassment. So these are the advantages of GST, which we are all are aware of. That is why GST is so keenly awaited. And this approach might appear to be simple to the common man, but may pose challenges to the industries, as it will involve two levels of consolidation. First, when the CGST is brought in, and then when the SGST is brought in. Finally, coming to the end of my presentation, some big takeaways. One is to reduce litigation in the country. So there is a clear need to reduce the litigation, and on that front, the Finance Minister has begun action. On indirect tax front, the scheme of advance ruling has been extended to resident private limited companies. The amendments proposed in the appeal procedures by making mandatory fixed pre-deposit for appeal. So if you want to file an appeal, there is a deposit that you have to keep with the appellate authority. So that has been amended. So I think that will also reduce the litigation, because otherwise there was frivolous litigation happening. On the direct tax front, in order to reduce litigation, just yesterday I think a circular has been issued by CBDT increasing the limit which has to be followed. So if the tax department wants to file an appeal to the appellate authority, they have kept a threshold limit that unless the tax impact exceeds a particular limit, only then can you file the appeal. So if the tax impact is less than that level, the tax department is not allowed to file appeals. So just yesterday, the level has been increased. I think for CIT appeal level, it was 3 lakhs. Now it has been made 4 lakhs. There has been an assurance in the budget speech that retrospective amendments will not be done in future unless it is extremely necessary, and the current one, as I said earlier, will be used very judiciously. The Authority for Advance Ruling and Settlement Commission related changes he mentioned in the budget speech, but there is no relevant amendment in the Income Tax Act. One hopes that they will come in. So these are the takeaways as far as reduction of litigation is concerned. Clarity and stability was required on various fronts. There were certain deductions which were available which had sunset clauses. So after 31st March 14 or after 31st March 15, that deduction was supposed to die a natural death. They have been extended either indefinitely or for a few more years. So that is very welcome. 80IA, for example, 32AC, for example, they have got a further phase of life. FII classification of income brings in clarity, brings in stability. REITs and InvITs, as I said, new chapter brought in. Again, it brings in clarity and stability. Amendments to the 54, 54F and EC, they may not be popular, they may not be liked, but they certainly bring in, clarity and surety about the taxation. And therefore, coming soon would be the Achhe Din, I think, which all of us have been hoping for. Thank you.